Welcome aboard. M. Solomon here, accountant, your auditor, secondary markets, specializing in wrongful foreclosures, foreclosure cases, settlement disputes. We got a good presentation for you today. We're talking about escrow accounts, nominees, and taxpayer form 1099. I believe you'll enjoy it. Let's get going. Quick study course, substituting discounts for servicing and prepaid escrow accounts. What does that all mean? Let me show you. When I first got into banking, I worked for a small thrift bank in Beverly Hills, and we specialized in these kind of loans that I'm going to share with you right now. They were hard money loans, equity loans. In other words, the borrower would have a first mortgage of say 40%, 100,000 on a 250 appraisal. We make a second loan for 100,000. That'd take them up to 80%. So the combined loan to value is 80%, 200,000, 100 first. We were in second. So second mortgage had a rate of 5%. That'd be $5,000 a year. What we do is prepay the mortgage for 3 years. 5,000 times 3 would be 15,000. So the gross loan that the borrower signed for, the note he signed for, was 100,000, but what he received in closing was a net amount of 85,000. He was prepaid. And that equates to a discount of 15%, or 5% per annum over 3 years. So although we funded 85,000, he was prepaid. Our demand for payoff in 3 years would have been 100,000. But here's the best part of all. Just because we discounted that loan by 15,000 doesn't mean we get to enjoy that profit. We only realize the amount based on time passing. It's not until the end of the first year can we realize the first 5,000. Second year, the next 5,000. Third year, the next 5,000. You can't realize it. You can recognize it, but you can't realize it. You got to have it in a passbook account, and the consumer needs to be earning interest on that. If the light bulb's not going on yet, think about why people are in homes now for 5, 6, maybe even 10 years without making a payment. Prepaid mortgages, escrow accounts. Look for that escrow account on your servicing statement. Send it to me. I'll show you where it is. Here's a case from Florida. It's a prospective client we're working with. And it's an interesting servicing statement. Let's take a look at it. We got a statement date of 3/1/23. And the next payment due on 6/1/20. Go figure, next payment due 6/1/20. Statement date 3/1/23. Yes, correct. That next payment due was from 6/1/20 to 3/1/23, but that is a cutoff date backdating to the next payment date. So that mortgage right now, I can tell you, is not in default. They are current. All I need to find here is an escrow account, and look what I got. Right next to the principal balance on the statement, it says escrow account. We had this other little number here, 258.98 random. Think so? It's not. But it does show a rate of 4.5%. That's all we need to get going on this case. That's all we need. I'll show you why. I carried it forward here so you can have a reference. What they're doing is they're taking 250, 733.89, and they're discounting at 21,850.82. Divide the two out and you get a discount rate of 8,715. You got that? That's a discount rate. It's not an interest rate. It's a synthetic rate. It's a coupon. It's a factor. But anyway, 8.715. Now, if I use the interest rate here they're giving me, I'll factor it against 250, 733.89. That gives me the amortization portion. That's not an interest rate. It's a rate of amortization. As you can see, it's 11,283.03. Now remember up here, discount rate 21,850. I'm going to subtract that from 21,850, and it gives me the balance 10,567.79. Factored against 250,733, a second balance, that comes out to 4.215. Here are the means and methods and the formula, the secret sauce or the McDonald's Secret formula, what is being used to create two balances. They're called contra accounts. You have two balances. This one here will amortize itself out, and this one here is treated as income, paid as rent. And what they both equal is capitalization right there. Another word for capitalization, because you have three balances here, amortization, accretion, and capitalization. Another word for capitalization is 1099 on your dime. After the sale, taxman comes calling. You don't want that. Take another look. Same statement. I'm giving you a reference here. Let's see what we got. All right. 250,733 divided by 250. Wait a minute. It says 258.98 here. Well, from my experience, did I just give the shop away? From my experience and the files that I've looked at, 250 seems to be a weighted average share price, which is used as a per diem across the board across the United States, which means all these mortgages are homogenous. They were all placed in the same pools, which would now explain the Y2K issue, and now everything was backdated to 12/31/99. But for the purpose of this, I know from my experience that 250 per diem is a weighted average for the final disposition of these assets. So let's see what happens. If I take 250,733.89 divided by 250, look what I get. Shares are per diem, whichever one I use, totaling 1003 days. What's interesting about 1003 days, too, by the way, is that is a borrower application. And this could be a code to indicate from one party to another, insider code, that there was a problem with the borrower's application, that the borrower never qualified from the get-go, whatever. I got 1003 days, and let's see what 1003 days takes me to. 1003 are the number of days from 3/1/23 to 6/1/20. Wonderful. Let's see what we got here. 3/1/23, 6/1/20. It's 250 per share. Now I think I know what the 258.98 is. Should we keep going? Why not? So we have a statement date, same document, same servicing statement. Using these numbers here as reference so I can show you the further analysis we did. We have a start date of 6/1/20. And we carried it out to 1/25/23. Department of Treasury says add 7. That's beautiful. Ties it out to 2/1/23. You have 28 days now remaining that will take us to 3/1/23 from February to March. There's your 6/1/20 to your 3/1/23, but now you have carve-outs, and this is how they do the carve-out. It's done by tolling. It's called a estoppel by latch. But I had 968 days first. How'd I get that? 250,733.89 divided by 2,598. Give me 968 days. Department of Treasury says add 7 to tie it out. I did that. And then there were 30 days left because the March 1st payment, which is being represented up here, statement date March 1st, would be due for the month of February. So what you have when you total all these numbers is 1003 days, which takes you from womb to tomb, 3/1/23. It's just a different way of doing a carve-out. And you can see here the fractions. 0.723 appears to be some kind of a banking fee. 2.876 appears to be the second loan's cost of funds for a warehouse line, and 103.6 appears to be the execution upon divestment of the asset. It was treated as a final sale, or a disguised sale, the IRS rules. This is not a mortgage, folks. I'm not saying it's something illegal, but the fact they're not disclosing it is very wrong, and that's the cause for a wrongful foreclosure claim, but that's not a mortgage, okay? It's called structured financing on the consumer's dime. Should we keep going? Let's go. Back to our statement. I had a few closing notes here. It's you who end up repurchasing your own loan at a zero value. You're the one who's attributed as an investor in a pass-through investment. You're a member of a partnership, tax matter partnership, liquidating the officers and directors' liabilities and bad assets. They're financing you and you're repurchasing them through the cancellation of debt by involuntary conversion. Keep believing there's a mortgage there and you've lost. Just move on. You're not going to win. There is no mortgage. Get off that argument. That argument will not survive in court. They know. You let them create a matching balance. How? I just showed you. From the first year's annual payment. That's what that represents right there, first year's annual payment. This is a scheme now taking us forward, closing out this period of time, and now a new bank steps in. They're off to the races again. You gave them a tax break because they get to cancel the debt and convert it into income paid to you. That shelters income. And it's you who are critical for converting a capital loss into a payroll expense. In other words, if they were to write off your loan, if they were told to write off your loan back in 2008 or 10, if they're told to write off that loan, that would be an absolute loss. Whether it's 10% a year, they write it all off the front end. Here, they get to expense the write-down on your dime, where you're the employee and they're paying you. And then guess what? They recoup it back as rent. It's a tax loophole. Ordinary income, subject to federal withholding from cancellation of debt, is treated as rental income. It's a tax loophole. You gave them title in advance in exchange for their bad asset. Like-kind exchange. You gave them title. And you lose a home at sale. So the home can be resold by a nominee using seller carryback financing. There's no real money here. It's the equity in your property. A few more things in closing out this case. I believe this case is in Florida, if I didn't mention that already, and it's a new client. Glad we can see that they're getting off to the right start, bringing in the right claim. Should be interesting how this case goes. Claims, counterclaims, and false claims. All amounts owed are paid at sale, attributed to satisfaction by the consumer. So you are paid as agreed. You satisfied all the debt. All properties are sold for zero in a constructive liquidation. So you are no reason to fight the means and methods being used where you have satisfied all the responsibilities and obligations of a payee, and we should get a 1099, which means state a claim for your title, your right of reversion. The mortgagor in these cases is a payee, is a party in possession. You're a payee, party in possession. And a payee is someone being paid by the employer or by the payor. So your servicers are paying agents for the escrow accounts, and those are for amount funds due the IRS. Beneficiary for the note is the seller and the landlord. It's not what you think. It's not the mortgagee. Beneficiary for the note is now the seller and the landlord. MERS, incident to a debt, as a seller. It's a fact. Equitable title transfers to an indenture as a disguised sale. Look up the IRS rules for disguised sale. Mortgage is converted into seller carryback financing. We already said that. That's your equity. You're buying back your property a second time. And the trustee sells back to you under a nominee MERS. We said that also. If you're glad you joined us, I'd like to leave you with this. The enforcement of the lender's collateral or a direct investment in issuer bonds converts the mortgagee's rights and entitlements in a borrower into COD income and consumer is a pecuniary interest. And that's a word you should maybe look up, Black's Dictionary, pecuniary. That interest is for any class of equities, securities, and it means the opportunity to directly or indirectly to profit or share in any profit derived from a transaction in the subject securities. You're a pecuniary interest. You need to raise that claim. Tell your attorney that. Listen, I'm looking forward to meeting you and hearing about your case, and if we can, we'd love to take a look at it. If we find something, then we'll ask you to engage us. If we can't find anything, we're not interested, and you shouldn't be interested in engaging us. But we'll always look first, and there's no cost. Send your file in. What I'm looking for is servicing statements and payoff demands. Most importantly, payoff demands. If we find what we're looking for, we'll alert you, and then we'll go from there as far as what the cost is for our testimony and for our affidavit, for depositions, and for providing your attorney whatever else he needs in terms of discovery. I'm M. Solomon, accounting, auditing, expert witness for rights and property, not an attorney. Not posted for one's legal rights and property. Only an attorney can represent you for that. We're accountants, and we're here to testify as your expert witness. Thanks so much for joining us, and take care.